What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. That sounds like something you're interested in. Consider subscribing, as I do provide other additional content on at Hemi137 on X as a daily pulse of the market. And I'm actually thinking about dividing essentially this video up between essentially recap and what I'm looking for in the next current week, and then break off essentially just the charts in themselves to an additional video. So I'll do that during this video. So if you feel like you're missing the charts, I'm going to go ahead and create a different video for that, and I will load that tomorrow on Sunday. And then that way, you guys, if you guys are just more into charts, then you can check out the charts. Or if you guys are more just into my current market pulse, I will separate those two videos so you have them. I would like to get more into some of these other different aspects of the market and get more granular about it. That way we can get more insight and specialize in certain things. That way you don't have to watch a 30-minute video, 40-minute video, because I know it can get long after a while. So with that being said, remember to subscribe so you can catch those additional videos. So with that being said, let's look over this past week. Now, this whole time, these past 2 weeks, we have gotten so much critical information. And this week, even more big information is dropped. Now, to try to put everything back together and try to paint this picture of where we've been, I've said from essentially the beginning that there's always two different perspectives. There's this utopic perspective that essentially needs to remain intact so that the overall general society as a general doesn't go start getting chaotic and start losing their mind, because if you start creating panic, you cannot control the masses. So a utopic perspective needs to be placed out there. Then you have the realistic scenario, what's actually going on. The markets, the more you get into markets, the more you realize the markets are actually telling you what is really going on. Now, there's a lot of very lagging data that a lot of people go off of, and I've stated this multiple times. You can't go off the data because it is lagging a lot. Something I've talked about: when interest rates started being hiked, it's a very lag effect. It could take up to 6 months for that first rate increase to actually start making some sort of impact. And the justification behind that is because you have to wait for a lot of business loans to essentially wait for their current loans essentially to expire, and they have to get new business loans. And so then they get essentially introduced into new higher interest rates, which are much more expensive, which is making it much more unaffordable even for businesses to operate. And then you have the very interest sensitive category, which essentially this is where your home loans come in. This is where your automobiles come in, which automobiles right now are getting absolutely crushed. The home loan industry is up to 8% now, I believe. They're expecting 10%. So just keep that in mind. Again, the 7% isn't a bad ratio, but the problem being is that people are still price gouging on homes. And so homes are like 3 to 4 times what they were just 2 years ago. So that needs to correct because it is very much unaffordable. And right now, a lot of people have these, 2 to 3% interest rates from just a couple of years ago. So they're holding on. And right now, all the wealth is essentially in the older generation. And they are supporting their whole family at this point. It's to the point to where a lot of families are moving in together to try to cut costs, because things are just absolutely absurd when it comes to trying to go out on your own and make a living. So with that being said, this leads us into this week. All right. We had a crazy week last week with Tesla. A lot of people don't understand why Tesla was shooting up. You got to understand the market. The new market is very different from the old market, and it will always keep changing and adapting to the current atmosphere. So you have to realize that and understand that the reason why Tesla was selling was because of the concern why EV was essentially getting crushed. And again, it's placed very much in the EV sector. You have to understand it is very much an energy, AI, technology corporation, and people just don't understand that, and understand that when Elon came out and talked about robotaxis, talking about humanoids, yes, we don't know how far that is. I think it's we're closing that gap very quickly, but again, I think Elon even coming out on his best foot. He may be reaching a little bit because I think it's still a little too far out. But nonetheless, again, he still covered his butt by saying that they do have a lower cost vehicle. That initial report that came out was they're essentially telling lies, that there was no desire to cut the cheaper vehicle. They've been cutting the price of their cars anyway. Now, just in general, the EV sector is absolutely getting crushed. Either they're all gone bankrupt or they're penny stocks right now. So yes, EV sector in general is being hit. But Tesla as a whole, just as a car industry in general, is doing way better than any of the other car industry automobiles out there. Toyota is probably, again, the one that is still long lasting because of the durability. And then ultimately understand there's a lot of new cars that are still sitting on lots and they are not moving the metal. They are sitting there because, again, there's still a lot of auto dealers that are still price gouging as well. And so just keep that in mind. And again, one of the biggest inflation markers that we have is used car maintenance, because of the fact that people aren't able to afford the new cars. So now you're seeing a huge spike in used cars, and essentially them being able to price whatever they want, because people can afford the smaller payments, but they can't afford a brand new car, considering that insurance is also going up on top of everything. So with all that being said, let's get down to last week. Last week we had some big earnings. First things first, I should have I'll probably actually put Amazon on here first. They were on Tuesday. The strong growth is still going to occur with Amazon, even despite as big as it is. Once we start introducing AI into the multiple different industries that they are in, they will absolutely dominate. You have to understand that if you are AI and infrastructure, which Amazon is very strong in both of those segments, that they will continue to do well, despite a lot of other industries that they do operate aren't doing as hot. But again, ultimately understand that they are supported by the massive amount of growth that's coming through AI and infrastructure. And they host the cloud infrastructure, and they got a lot of AI components to that are really that essentially conserve time. That's the biggest thing when coming to business right now is the best bang for your buck, given that inflation is so high. So Amazon did do well. I expect it to do well for the next, probably a couple of years. I think at some point it's won't be there strong forever, but it is pivoting really good, just like Tesla is. And I believe Tesla and Amazon will do really well into the future, as they are pivoting into a lot of these different things, and they have great CEOs to do that. Apple, however, hasn't done that. Tim Cook hasn't been innovative. He's tried a lot of different things that have just been burning cash like crazy. Apple did beat expectations, and something I talked about is expectations are in the dirt. So you don't really have to do much but show up, and that allows you to essentially get credit. And that's essentially what happened. Apple exploded up. But when you look at Apple from a broader perspective, 10% revenue loss on iPhones, that means their whole company is getting obliterated. That was their biggest revenue gainer, and they're losing steam on it, and big part of it being because of China, but it's across all industries. India and the US, sales have dropped. People don't have the excess money to be upgrading on these things right now. So yes, they will take a heavy beating. Year over year, their revenues drop 4%. Berkshire Hathaway starts cutting their investment 13% of Apple. Apple's innovation is not there. Now, they came out and said that they're going to announce something this week, I think on Thursday, from some AI and what they got going on. Again, they're going to have to make a big change. They came out with Apple Pro Vision, which helped some of their sales initially because it sounded exciting, but only to find out there was a lot of really bad reviews about it. So yes, even though that can be innovative, there's still, it's the headset I'm hearing is really bulky and all kinds of issues with it. So again, there's still a lot of issues with Apple. Apple isn't innovating, and then again, this past year they've essentially scrapped the whole car project. It was a complete waste of billions of dollars. And then now again trying to shift into AI. So we'll see what they come out with this week. But as of right now, Apple is not in a good state. Yes, they raised their dividend. Yes, they also had a very historic buyback in 100, I think it was 100 billion in buybacks, and again trying to keep their stock afloat. And that's why you had a push up. If it wasn't for the buybacks, Apple would have got obliterated. But that is why they're essentially saving their company from extinction at this point. You have to understand that they're not going to be there forever. Yes, they have a great product, but again, that's it. That's all they have, right? And if you can't continue to innovate, then it's going to be a problem. And again, with people not having excess cash, and considering that, Apple at one point was a very secure product, but as of recently, that has not been the case. There's been a lot of different hacks and everything going on with Apple, and what's being highly concerning. So that one aspect that they did have of their product isn't so much the case anymore. So again, Apple is one of those things. The juggernauts can't always stay on top. At some point, they start turning over. Now, Apple has enough money they're in a position to where they can change it, but they're not doing it quick enough. They're again burning too much cash for something that they're not innovating in, and not bringing a type of sticker flash kind of product like they did with the iPhone to the market. And so again, we'll see what happens there. But again, I don't like the position Apple is in. And another huge story this week, Starbucks got absolutely crushed. One of the worst earnings we've seen in a very, very long time. And Starbucks, of all people. So you should notice there is a theme going on here. So despite this utopic view that I was talking about that tries to be painted that everything's strong and resilient, your best companies are getting crushed. Starbucks companies wide same store sales fell 4% when traffic fell 6%. China's same sales plunged 11% with an 8% decline on average orders. International same store sales fell 8%. Management lowered revenue growth guidance from 7 to single digit lows. One of the worst. Even the CEO, even Jim Cramer, get on the action and interviewed the CEO of Starbucks, and absolutely just handed him his ass. It was hilarious. Because as a CEO, you should have came out and told investors a month ahead of time, things are not looking good. On the same case, if you were doing good 30 days, you should be saying something, right? And he didn't say anything at all. And so he just was trying to come up with an action plan, which is great. But on the same token, you still need to be informing investors about how bad it was. And they got obliterated. McDonald's, I don't have on here, but McDonald's, their forward guidance is not looking good. Again, with the wage increases that they're being forced to have to increase to $20 an hour, they can't afford people. They can't afford to employ people, right? You start cutting way much into the margin. And so, again, a lot of this is why the layoffs occur, because now they're trying to figure out every single way that they can to try to save profits. It's just like with Meta, with their massive layoffs with a bunch of executives. They laid off managers of managers of managers. Why do we need so many managers? And so these are things people are trimming fat. They have to remain light and agile in this current market with these rates and where they're at. This is what happens during every cycle. And now I know it's been a very long time since we've had this kind of atmosphere, right? It was just a very utopic atmosphere when we got 40% of the money supply printed into. This is where a lot of people got into the markets and thought everything just went up because they printed so much money, and then now realizing that that's not sustainable. And that's what we're seeing is we need correction, we need normalization of all markets because everything is way too high. DoorDash reported a $21 million loss. CVS, pharmacy net income fell by 50%. That was just the other week. And so being said, and this is also why Meta fell. People are like, well, why did Meta fail? Meta and Amazon have had the best earnings so far. Out of all the earnings that we've seen out of big tech, they have had the best earnings. But the problem was Zuck was still spending billions of dollars in a time when people are concerned about what's going to happen in the coming months. And a lot of these forward guidance, again, if they are still, especially some of these smaller companies, which you'll see is we're going to start getting into this week, is these smaller companies are going to get hit a lot worse. unless your overhead doesn't have to do. This is why technology can do so well in this particular atmosphere, because the overhead isn't bad. And also, again, it's like a 1 to 10 ratio. So you're essentially what you have to pay for a couple of developers, the amount of money you can get out of what they can create, through their code, through AI, can produce crazy amounts of profit. And so this is why, again, there's been such heavy push towards chips. And I keep trying to emphasize this. People think it's the dot-com boom. It's not the dot-com boom. This is real. What is going on is real with AI. And the massive amount of production and everything that is going to be able to be created. Even the CEO of NVIDIA talked about this, right? Pretty soon in the near distance future, they'll be able to put all the world's knowledge into one chip. Just imagine if you can compute all the world's knowledge within a matter of seconds, how much production you can get out of that. That's why there's such a huge race for this stuff. And it is very much a realistic expectation, as a lot of people think it's just, you're talking about a lot of scientific stuff. You're not. This is the real deal. Now, given a lot of the use cases have been pretty shitty, you still have to understand that it is very much the real deal, and the massive amount of production that it's going to be able to produce is great. And then you're going to have humanoids on top of that are filling a lot of the gap. What does that do to the human race? Right? We're going to innovate. We're going to adapt. That's just the way we are. But again, ultimately understand that what we need to be doing is that a lot of robotics and stuff are going to be taking over. A lot of these jobs that, again, because of inflation, people can't work because it's just not worth their time. But we have to still fill those holes. These stuff still has to be completed. This is why, again, a lot of people like plumbers, electricians are going to get paid a fortune, because we still need a lot of people to do these jobs. And so with all that being said, again, earnings and general sentiment is, if they are doing well, it's because they're an AI infrastructure. That is why they're doing so well. Again, if there are other companies outside of that, either one, they're getting absolutely obliterated, or two, they're on the cusp of getting obliterated, and they're talking about that in their forward guidance. And that's what we've gathered so far with all the industry leaders. Now this week, we're going to start rolling into more of the mid to smaller, essentially, companies, and really kind of get a grasp of what's going on there. Now let's look at Powell. Powell came on this week. We had monetary policy didn't change. That's what was expected. He came out saying he's not seeing the stag or the inflation in stagflation. Yes, we are in stagflation, which is the worst case scenario. You have unemployment that is increasing, and given, they can say whatever they want about the current numbers, and we've talked about pencil whipping and revisions that are going on. We're going to see double-digit unemployment. There's tons of jobs out there, but I can tell you this, is that there are tons of jobs out there that no one's actually hiring, or there's nobody there to actually onboard people, because they are such skeleton crews right now, that piece of it that he's talking about is a bold-faced lie, because it is really bad already. And a lot of these people that are getting let go are finding it extremely difficult to find other jobs. And so so stagflation in itself is essentially inflation going up, while you also have unemployment increasing as well. Wages can't keep up with inflation. So you have all these three worst case scenarios occurring at one time. So you essentially put the Fed in a position. They're going to cut rates because of unemployment. They will do that. And I think they're aiming, it seems to be like June, that they're going to have to cut, because what we've seen is that these past two earnings cycles, the deeper we get into these earnings cycles, the more of rapid increase in unemployment that we're getting, again, because like I talked about, essentially these companies are getting to the point to where, okay, now their loans are becoming mature. They have to get these new interest rates. They can't afford as much as they could a couple of years ago, where they were just spending like crazy. So now they have to start cutting laying a bunch of people off. And so now a lot of these, they can't afford to have massive amount of crews like they couldn't. And so Tesla is still doing more rounds of cutting of executives, right? It's a big problem, and we can't have a bunch of executives when there's no workers, right? That's you. You need the production workers to be able to keep up with production, and so he said they're unlikely to hike on the next monetary policy. We talked about this. There'll be a cut. I wouldn't be surprised if we cut and then we start increasing even more to where we're at, because once we get that first cut, you can guarantee inflation could potentially start rising up, especially given the current market sentiment. So we'll see how that does play out. Again, they keep trying to downplay the inflation, but the problem is inflation is very much there, and we are seeing stagflation. And the definition of what stagflation is, and what they are trying, again, they're trying to push back to this utopic view, which is not correct. Unexpected weakness in the labor market spurs rate cuts. So if they essentially saying that if it does happen at essentially this point, which I've talked about, that they're going to have to cut rates, right? And so just keep that in mind. It's something very much that's going to happen, and I think sooner than later they're going to have to cut just because of that. But the problem is 25 point basis move cut isn't going to do anything. It takes months to see the impact of what that's going to do, again, because you're talking about the loan process and waiting for these companies to mature. So again, you can cut today, but you're not going to really know the impact of that until months from now. So that's what I'm saying. It's very difficult because it's a very much lagged indicator, and you have to understand that things are going to get extremely bad before the Fed are like, whoa, we need to let up. But things are way too bad. And then that's when they start emergency rate cutting, here 100 points here, 25 points, because it's just gotten so bad that they have to start, just like we saw in China. That's exactly what's going to happen here. Is they start having to pump back into the market, money back in the market because of that problem. And so again, what we've seen in China, what we're seeing in Europe is what we're going to see here at any moment. And so again, you've essentially crushed a lot of people's expectations, blown everybody's savings. When it gets to that point where you start cutting, people aren't just going to come swelling back in the market and start buying stuff. They have no savings. They have nothing. You have to understand it's not going to be like these people are talking about when, these houses go back on sale and, the prices start falling and the rates start cutting, that everybody's going to run back to house. People don't have any savings. They don't have any money to do anything. And so that's the problem. And so again, don't lead into a lot of these false expectations about what's going to happen, because right now people are in a very, very bad state, and it's not going to be just a quick turn. Let's start cutting and things just get better. Now, I've talked about this, it's going to be multiple years. The markets will recover a lot quicker than the actual economy will, but you need normalization of housing, of auto industry, so people can actually want to produce so that they can go out and buy things. Non-farms came out. So this was unexpected that it actually dropped like it should be doing. So we came in at 175K versus 238 expected. Again, a lot of pencil whipping there. These numbers are going to all be revised like they continue to be. That we were in a depression, because at this point, it's pretty much what it is people are skipping meals. People are living together. People are doing whatever it can. They're cutting their Starbucks. They're cutting fast food. They're cutting whatever expenses they can. They're going with name brands. You can look at Target and Walmart. They are buying, store brand. They're not buying the expensive brand names to try to save $1 because things are just way too expensive. So you have to keep that in mind. Over the past week, yet again, USDT to the yen ratio crashes against weakest level since 1990. Again, there was a lot of big problems going on in essentially in the background that you are unaware of. If you were aware of what was actually going on, you would lose your mind, right? And it's a lot easier just to turn the other cheek and pretend not to see a blind eye when you got the administration trying to push another 45% capital gains tax. How much more tax do you need? Stop the spending, right? Because just because this 25% capital gains tax is for the rich, this is how it starts. It starts for the rich, and then essentially spreads out to everybody over a matter of a couple of months to years. You have to understand this is the same playbook that occurs over and over and over. And the more you want to break out, the more you don't want so much government controlling every aspect of what's going on. because it leads to corruption. And so, with that being said, let's take a look back. Now, this bank, Republic First Bank failure that occurred last Friday. Again, I want to emphasize this. This is a huge problem. This bank only, I think, had $6 billion. This is a very small bank compared to the three behemoth banks that we lost, which FDIC is still holding First Republic, a large amount of First Republic loans. I think there's only like 5% that they aren't actually holding because nobody wants to buy that debt. Nobody. And guess who gets to pay for the debt? The taxpayer. And with that being said, you had a very small bank get bailed out because they're worried about the essentially the domino effect that can occur with bank runs if you don't support these people. So essentially, what they are doing is if you are over the 25K mark, which there was quite a few people, I think it was 45% of the people at Republic First Bank were over the 25K mark. And so essentially they were screwed out of that money. And to prevent chaos, they essentially bailed the bank out. They bailed everybody. If you were over the 25K, it doesn't matter. So essentially, what happens to the other people, right? You are essentially taking 250K away from people. There's only so much allotted for these people, for these banks that is put aside for these banks. You are dipping now. So essentially, this multimillionaire who didn't essentially dilute his money to multiple different banks, multiple different accounts. So that was the way he made sure that his 250K was covered by FDIC. Instead, he is now over. So now people who may fit the 250 or be under that 250K may not be able to be eligible to get their money reimbursement because of the rich. And so again, it's a lot of problems, but again, it still stems back to the banks and the way the banks are set up, the way the debt market system is set up is extremely, extremely scary. And it's a house of cards. If you haven't heard it before, that's essentially what this whole economic system is based on. And so with that being said, audit finds 282 banks out of, I think it's about just over 4,000 banks, the U.S. banks at risk of failure. So there's still a lot of banks that are at risk of failure. I think you're going to get, as we continue to move on through the rest of the year, you're going to get more and more heavy, big news. And again, the Fed will not schedule a rate cut. It will be an emergency rate cut in reaction to what is going on. And that will strike in a lot of fear, again, considering how many rate cuts they may do. And then what you're going to have to watch is core inflation. What is core inflation looking like right after the fact? So these are the big things that you have to be paying attention to, because it's going to be a big problem in the coming months because the rates have not changed. The rates are essentially the linchpin for everything. If you don't watch a lot of news, just watch for rates. Are they increasing or decreasing? If they increase, that's going to draw panic just as much as a cut is going to as well. A cut might actually push up the market because they're going to think, oh, it's a cut. That's great. But you have to understand, if they're only cutting 25%, that doesn't do anything. So then you have to understand that it's going to start saying, oh, well, why are we cutting? Is because things are so bad, right? So if they just do 25 basis point cut, again, that's not going to do anything. And when people realize that they make the cut, yeah, we may start pushing up a little bit because we got a cut. But you have to understand, before they start emergency rate cutting a lot, that's when the real panic comes, because they're like, oh, well, I thought I cut would have helped, but it didn't really help because now we got to do a lot of emergency rate cuts because of X, Y, and Z occurred. And now we're double-digit unemployment. And then you'll see the pricing of a recession, and it will get really nasty from that point. And so you have to be mindful of that. And again, we have been doing rolling recessions. We don't know how deep this pullback can be. We've been pulling back quite a bit since kind of the beginning of this year. But so you have to keep that in mind. But again, ultimately understand that, again, they will try everything to keep this market propped up and strong and resilient until after the election. That way, whoever's the president coming into the new year will have to deal with it. But again, you can only do so much before it caves, and we're getting to that point where it's accelerating. We're not sure if if it continues to accelerate at the pace it's going to happen. I would see June something bad happening. So again, it would be some major crisis, banking crisis going on, that will essentially created the whole thing. And again, talking about the Republic First Bank, again, there was laws made back in 2008 to prevent this from happening. There is nobody out there checking FDIC saying, hey, you can't just do that. This is supposed to be, safe for the large banks. And now you're going out saying that $8 billion bank. Are you serious? Like, that is what's the concern out of what happened with last week's bank failure. And understand it won't be the last. The banking crisis is still very much alive and well with, the interest rates are where they're sitting at, and the massive amount of bonds that all these banks bought essentially for corporate real estate that nobody wants, that you're seeing. There's tons of headline news with that as well, about people selling these buildings for fractions of what they paid for just a couple years ago. Right, $100 million buildings are selling for $5 million. Right, it's crazy what's going on right now. It's a repeat of 2008. So with that being said, let's get into some of the other things. So upcoming week, there's nothing major scheduled from what I can see, but I do see there are a lot of Fed members speaking. Given what happened over the past 2 weeks, now there's going to be a lot of discussion about rate cuts, rate increases. That you have to understand, this is going to be very big this past week, and considering what's been going on, people are highly concerned, especially with a jobs report, a GDP that's dropped down tremendously, a job reports that's dropped down tremendously, horrible earnings from industry leaders. Now you're getting some of the predominant mid to smaller companies that have a lot of potential. Now they're going to start getting hit and sideswiped, and then essentially got the Fed coming out talking about rates. So again, I expect a lot of big headline news coming out this week and next, and then it's going to start dying off, essentially waiting for NVIDIA earnings. And then essentially that will kind of close up earnings, and then there'll be earnings obviously all the way to the end of the quarter, but then we'll have to wait for the new earnings cycle to come back around. So a lot of Fed this week. Monetary policy, the next one is until June, so keep that in mind, June 12th. Core is on the 15th, so we don't have core this week. It will be next week. It's going to be extremely important. If we have another high core inflation report, that is going to be a big problem. That will essentially solidify your stagflation. And again, if it is stagflation, again, they will wordsmith it to make you believe that everything's okay. Until it all comes crashing down, they will come back and revise everything and tell you, yes, you were in a recession for X from this time to this time. It actually got into the point where we were in a depression, and you were working through a depression. If you just take a step back and realize what's going on, people are living with families. People can't afford basic expenses. They can't afford the expensive coffees. They can't afford expensive fast food. They can't afford all these expensive things. Living off of store brand names would tell you that we are in a depression. With that, some upcoming earnings. What do we got this week? We got some really good earnings. Like I said, a lot of the big ones were reported. We got one more big one in NVIDIA, which I got to look and see what exact date that is. But this is what we got. Upcoming earnings. We got Palantir. I want to see really what's going on with them on Monday. Again, their AI, all AI based, and their product is very, very good. And again, their overhead is not much at all. Yes, they got some expensive engineers, but again, ultimately understand what they produce and what it can create for your business and make your business it completely changed the dynamic of your business. Like, I highly suggest that you look at I'm not trying to sell anybody on this, but you need to look at what they've done. They actually came up with a demonstration with football and how you could use your project, essentially use their essential tools to make your operation proficient at its finest, like fine tune your operation, your business, and what it can do on any field. It's adaptable to any industry. It's amazing what they are doing there. And I think still very undervalued because Wall Street doesn't understand what they have, what Palantir has. Tuesday, we have Disney, Celsius, and Upstart. Again, they'll give you good pulses of the market. Expect Disney to get walloped. Celsius is good. Energy drinks do really well. So I still think they could it's another Monster energy drink. If you have seen the massive amount of increase that Monster had back in the day, Celsius is the new Monster as far as it's one of the fastest growing companies out there. So just keep that in mind. So it'd be good to keep them watch. Upstart, again, a lot of potential there, but again, ultimately understand the whole baking sector is kind of just being walloped behind the scenes. So then on Wednesday, we got Shopify. It'd be interesting to see what happens there. Again, not really expecting a lot there. I think they could still get hit pretty heavy. They offer great products, but again, nobody is buying, and that's the problem. Is people may be trying to get innovative and try to open their own business. They may do really well because they're trying to make some money. They need to try to make money somehow, some way. And so if they have to create their own business, maybe it's in the AI or technology space, that could be really beneficial for their potential company. So just keep that in mind. ARM is a great one to start keeping on. ARM is one I want to start talking about more. NVIDIA tried to buy them, but they were denied because it essentially would make them a monopoly. They're essentially the NVIDIA version of mobile devices. So ARM is going to be one to really watch out for. I want to really keep a close eye on that for its earnings on Wednesday. Airbnb will give you a good pulse of the market. I really liked Airbnb before, but I think Airbnb, the whole thing needs to be, we need a hard reset just in housing in general. And so with that being said, Airbnb will, I think needs to take a bigger hit, but I think when it does, it can make a strong comeback. There's still a lot of issues it's having with, people renting out their homes and then these massive parties occurring in residential areas and people essentially kicking Airbnb out of there. So there is a lot of that going on. So that is concerning to some aspects, but again, ultimately understand, I think it's still a great business model to be able to rent out your property and make additional money off of it. So expected moves this week. We got the SPX at 62, Tesla at 10, and Boeing at 6, and JP Morgan at 4. So not really seeing much of a change. Looks like the market has really died down. A lot of your big industry leaders have reported. So again, unless there's major headline news, this is a great week. If there's some major news that drops with banks, that SPX would be perfect to take advantage of. You can get some major moves in SPX this week if there's major headline news. And this is the best way to take care of, or to use options in weeks like this, when you have some essentially, if you want to call black swan news that may drop, this would be the week to really focus on for SPX. Because if there's some major news and hurts all industries, we could drop pretty dramatically. Tesla's still a little bit high just because of a lot of the noise around Elon and everything that's been going on there. So that's still a little bit elevated. So with that being said, I'm going to go ahead and end this video. Remember to subscribe, because in my next video, which I'll try to put out tomorrow, I'll start getting into the technicals. So you can check out my technicals. And then that way I have 2 separate videos, and it makes it a lot easier if you just want one or the other. And if you like both of them, you can just check out both of them. So if you made it this far, I appreciate you. Go ahead and drop a like, and I will see you on the next one.